Well, good afternoon, everybody, and welcome to another interesting trading day in America, and also to a very interesting webinar this afternoon. Our presenter today at TradeStation is Mr. Jonathan Rose, the owner of Active Day Trader, or ADT if you prefer. He's going to talk to us about swinging for the fences, finding and trading inexpensive options. Banned my audio. Sorry. Jonathan Rose began his career on the floor of the Chicago Mercantile Exchange as a pioneer of computer-based trading. He was a key player in providing liquidity to the Globex market, and after 5 years of trading NASDAQ futures, he was recruited to join a technology-focused fixed-income trading firm. From 2003 to 2010, Jonathan was one of the 4 senior partners at a proprietary trading firm in Chicago. We're very happy to have Jonathan with us today for this presentation. He is very well respected in our trading community here in Chicago, and we want to welcome him to this TradeStation event. So let me remind you that our presentation is for educational purposes only. All the symbols and all the trading ideas that we discuss are for demonstration purposes. They're not recommendations. It's also not an offer or a solicitation of any kind in any jurisdiction where a TradeStation affiliate is not authorized to do business. Active trading is not suitable for everyone, and options trading does carry a higher degree of risk. It may not be suitable for all traders. We've posted in that chat panel a couple of pieces of disclosure information that you may want to click on and take with you. They'll open in another browser window, or you can read them later at your leisure on the TradeStation website. Right about now, everyone begins to wonder, are we recording this event? Will they be able to, find the event later? And yes, the answer is we are recording. And our presentation will be posted to the TradeStation YouTube channel later sometime tomorrow. We'll have it done tomorrow. And if you're a TradeStation account holder, you'll be able to find this presentation on VideoStation or on the TradeStation website. So let's swing for a couple of fences and generate returns through mispriced options. I'll turn things over to Jonathan Rose right now of ActiveDayTrader.com to help us figure out, to get our swings in order. Thanks, Jonathan. I could always use a little batting practice.
Yeah, well done. Lots of references tied in there. So yeah, thanks for the nice introduction, and thanks for TradeStation for having me. It's great to be here. So swing it for the fences, generate returns through mispriced options. What we're going to do is talk about buying options. Really what this is we're looking to buy out of the money options. Yeah, if we can find a price less than 50 cents, that's great. Risk disclaimer, looks like we've already been through. So again, I did start my career on the floor of the Chicago Mercantile Exchange in 97 to 03. And that's all I've done since throughout my career. Been a trader for 18 years. Traded futures up until 2010. I took a year off. I was under a non-compete. And after that, I was an options market maker on the floor of the Chicago Board Options Exchange. And that's really where I learned how to value options to the penny. So definitely very comfortable trading options and teaching options as well. Sean, need more volume? Need more volume to trade, or need more volume that you can't hear? Anybody else here okay? Pretty good. Okay, fantastic. All right, so again, this is exactly how I learned how to trade options. So we're going to look how to find and buy low-priced options, putting ourselves in position for returns without staring at the market all day and without feeling the need to really worry about your position. When I'm trading, when I teach trading options, I think it's really important to do your research before you get into the market, make a decision, and then once you make that decision, you got to let that position work. You could be in that position until expiration. It's really difficult to trade options with stops. So if you're buying an option, say for 50 cents, a call or a put, You buy 10 for 50 cents, it's $500. You really don't want to have a stop at 10 cents or 15 cents. The options markets, you give up too much edge getting out on bids to get out and offers to get in. So once you're in those trades, I like to think of it that you're in until expiration. So super excited to be here today. What would really help in the beginning of this presentation, because I'm going to go through some training, because I want you to see how I teach options. If everybody could help me out and let me know about your options experience. If you can, maybe between 1 to 5, and 1 is I have no idea what a call and a put is, options are really intimidating, and 5 is whatever questions Jonathan asks, I'm going to answer every single one of them. I am extremely comfortable with options. So if you guys could just help me out there, that would really help as I go through and get to the meat of the educational side of the presentation. Awesome. Can you guys see? I'm not too familiar with this platform. Can you guys see the chat? Can you see the answers? Okay, you could. Good. Awesome, awesome. Okay, so it looks like overall a few 1s, 2s, but definitely a lot of 3s. Very, very cool. Okay, that's very helpful. You guys are being honest. Sometimes I get on these presentations and I see a bunch of 5s that just kind of rip down the chat, and then I start asking a basic questions and I get no answers. Well, if you have no idea how to trade options, you're in the right place. So again, trading options are just a derivative of stock. It's the same thing. So if you're trading stock, it really would make sense to add options into your trading approach, because again, it's just a derivative of stock. I've already went through the background. What I want to do when we're trading is we want to look at things from a logical perspective. I always want a reason for being in every trade that I do. And a reason for me, technical analysis alone is just not enough. So I personally don't think just trading breakouts or double bottoms, triple bottoms, whatever, are enough to make a trade decision. I want a reason behind every trade, and then I'll use technical analysis as a one tool or one feather in my cap. There you go. Angelina, one option made $100 and is ready to learn more. That's all it takes. A little something to kickstart the journey. Buying options. Whenever you buy an option, if you buy a call or if you buy a put, if you buy a straddle or a debit spread, whenever you buy options, you're long volatility. Right now, the VIX is going higher, right? The VIX is what? Trading at 40? So those that are long options are benefiting from this move. Because whenever you buy options, you're long movement. You want craziness. The opposite of that is when you're short options. When you're short options, and short options might be short a call or short a put, or maybe you're short a call and a put. If it's at the money, that'd be shorting a straddle. When you're short options, you want quiet. You want the market to hibernate. You don't want anything to move. You just want to collect that premium. And that's going to be the key difference between being long and being short options. My goal for this presentation is really that I want you to see that there's a different approach to the market. And I want you to see how I teach, how I explain options, and see if it resonates with you. These are the kind of trade ideas that we look for. YRCW. Here's an example of a trade idea right here. YRCW got hit really hard after earnings and was down 50%. I was on the conference call listening, and I didn't think that there was any reason why the stock had to be down 50%. There wasn't accounting problems. There wasn't tail risk. It was just a bad quarter. So in a volatile stock like this, I sent out a Premier Member alert to my members just saying, hey, the stock has gotten hit too hard. If you're looking for something to do, consider the 9 strike or the 10 strike calls. If YRCW bounces, it should really get moving. And those are the kind of opportunities that we look for. If you can buy a 10 strike call for a dime, you can buy that 100 times. And it costs $1,000. You can buy it 10 times, it costs $100. It's a great way where you can have a defined amount of risk and unlimited upside. For those of you who don't trade options at all, I posted this just so you can see the exponential growth of the options market. The options market right now is bigger notionally than the underlying equity market. So if you're not trading options and not learning about options, you're really missing half of the overall market. Let's get into an example. And we'll use a phony baloney stock, ABC stock. And let's use the example of, let me get my little pen here. Stock's at 10, right here. Let's buy the 12 strike calls. They're for 40 cents, and let's buy 10 of them. If we buy 10 of them, it's going to cost us $400. The way I want you to look at this trade, we're buying 10 of the 12 strike calls for 40 cents. Stock's at 10. Think of it like you're getting long 1,000 shares of stock at 12. Okay? If you buy the 12 strike calls 10 times, stock's at 10, you're long 1,000 shares of stock at 12. That's how you can look at it. Now, why would you want to be long 1,000 shares of stock from 12 if the stock's trading at 10? You get a lot of leverage to do that. It's a $400 trade. You can buy a one lot, it's $40. The great thing, if ABC goes to 0, you can never lose more than you invest. As ABC stock rallies, and it goes to 11, it goes to 12, 13, 14. When ABC stock goes to 14, we're long 10 of the 12 strike calls. If we wanted to get out of this position, what are some things that we can do to get out of this position with the trading at 14? We're long 10 of the 12 strike calls. It's trading 14, and we want to get out. We want to lock in our money. We don't want any more risk. What are some of the things that we can do in order to get out of this position? Sell the calls. Long 10 calls, sell the calls, sell the close. What else can we do? What are some other things that we can do? If we sell the calls at 14, they're probably trading for $2.40. You make $2. We make $2,000 less the $400. You make $1,600. Great trade. What are some other things that we can do? Okay, we could sell 5. We could sell half our position. That's fine, but within the rules of the game, if we want to take off all of our risk, we would still have risk. So sell half and hold it. Roll it. I think that means that you want to go to the next month. Sell 12 strike puts. Jim, we wouldn't want to sell the 12 strike puts. That's not going to cover the 12 strike calls. This is what I like to do. You don't want to buy puts either. So you can really do 3 things. You could get out of your calls. You're long 10, sell 10, take your profit and run. Great trade. You could also sell a higher strike call, put yourself into a vertical spread. What I like to do is I don't want to cover my options, especially now with the VIX at 40. The most valuable thing that we have in this trade is going to be what's called our optionality. Here's what I like to do. What about selling 1,000 shares at 14? We're long 10 of the 12 strike calls for 40 cents. Stock goes to 14. We want to lock in profit. What about selling 1,000 shares at 14? What would that do? The benefit of doing that, it's not going to give you a credit. If you're long 10 of the 12 strike calls, remember earlier you're long 1,000 shares from 12. If I sell 1,000 shares at 14, at expiration, I'm flat. I don't have a position. I'm long 1,000 at 12 and I'm short 1,000 at 14. If the stock goes up to 100, I don't get to partake in that because I'm long 1,000 from 12 and short 1,000 from 14. The great thing about learning how to trade options like this is watch what happens if all of a sudden ABC stock comes out with accounting problems. If ABC stock comes out with accounting problems, before expiration, the stock drops down to 5. Now, since I sold 1,000 shares at 14, I can buy those back. I never touch my options. My 12 strike options are going to be worth 0 because now the stock's at 5. But I made a trade that instead of getting flat in this example, just made $9,000. Does that make sense, guys? Of why I would want to do that? The point is, whenever I'm managing options, I prefer to manage it using stock. Because what happens when you're long options, and many people are scared to be long options, to buy options. Tevis, thank you very much. I appreciate that. Many are concerned or scared about buying options. Has anybody ever been taught you should never buy options? Buying options is dangerous? Okay, a lot of people teach that. The reason, at least in my opinion, why that's taught is because when you're selling options, you're going to win most often. But when you lose, you have considerable risk, more than you're going to make. It's like risking $5 to make $1. When you buy, you could risk $1 to make 5. Well, Tucker, that's why I'm here to teach you. Here to show you different ways of approaching the market. We'll go over this some more. I'll explain more of what this is. Again, you got it, Tucker. I was told never to buy options. Most people, if they're teaching never to do something that half the market is doing, there might be some curiosity in learning how to do that, right? Half the market's buying, half the market's selling. So let's get into some more education. Buying options versus selling options. Patricia, of course. So when I teach, I'm going to teach about what the capabilities, what you can do in the market. But yeah, if you're trading a smaller account, if you're trading in an IRA, you have limitations. But you still need to know what's available to you as a trader. And then you have to work within your constraints. So buying versus selling options. This is really important to know. It's very general. But again, when you buy options, on the left, you're going to be in debit spreads, or it's a debit. You're most likely going to lose most of the time. But when you win, your winners need to cover your losers. Whenever you buy options, calls or puts, or a debit spread, you want craziness. You want things to move around out of control, like the environment we're in right now. I think of it as risking $1 to make 5. When you sell, it's the opposite. When you sell, again, we're risking 5 to make $1. You're going to win more often than not. 60 to 90% of the time, you're going to win. If somebody could, I can be in front of you right now and show you a strategy that makes money 99% of the time. But that 1% of the time where you lose money, you should be really, really concerned. Because if you make a penny 99 times and that one time you lose $1.50, that does not sound like a fun strategy for anybody. When you sell options, you're going to win more often than not, but when you lose, you have to be really, really careful because you can get really hurt. Most people across the internet, all these different gurus, are going to teach selling because we've been in a low VIX environment, and plus people can get comfortable because they're going to make money on their, on most of their trades. And if the market goes crazy like it has, then you're going to be in a lot of trouble being short options. Does anybody know what this is? Anybody tell me what this is? We got a small group here, so I'll throw this out. If anybody could, free workshop for anybody who could tell the first person to get the right answer for this guy. See, that's all you had to say. Nice, Doug. Doug got it. He probably whoopsie daisy on the question mark. You knew that. Doug, you win the workshop. You got it, buddy. So what this is, guys, these are the inputs to the Black-Scholes model. Okay? Black-Scholes is used to price like 97% of options across the street. Now, why is this important? Not because I want you to input things into Black-Scholes and learn the calculation. You don't need to do that. Here's why this is important. And let's use the example of Apple. We're trading Apple options. If I want to make a trade in Apple options, I can find the underlying stock price, right? That's given to me. The market's going to give me that. Whatever strike price I want to trade, that's given to me. How much time until expiration? Well, February, it's got 7 days, that's given. 36, 35 days out of March. Risk-free interest rate, use a 1 year, use a 2 year. Volatility. Volatility is the only subjective component of options valuation. The other four are given to us. They're on a silver platter and they hand it to us. The only thing that we need to figure out when you're trading options is what's the volatility. So I put this slide up because I want you to realize that if you're trading options right now and you're not using volatility, you don't have a good understanding about volatility, hopefully this slide can show you what a just complete disadvantage you're at. Volatility, it's the only subjective component of options valuation. And that's why it's so darn important. So let's go through an example between a low vol stock, low volatility, and a high volatility stock. So a low volatility stock, what's a low vol stock? Microsoft, Apple, right? Low vol. They're not moving very quickly. Maybe low vol stock has got a range of a low of 19 and a high of 21 in the last 3 months. On the right is going to be a high vol stock. High vol stock is anything with the word blockchain in it. A high vol stock is going to be solar stocks or gold miners or whatnot. So Andy, right now, let's not talk about liquidity. Let's talk about volatility, because you could have awesome liquidity in low vol stocks. You could have awesome liquidity in high vol stocks. You could also have terrible volatility, terrible liquidity in low and terrible in high. Okay, but the liquidity is not going to affect the volatility. So here's the example. 30 days to expiration, low vol stock 30%, high vol stock 70%. The low vol stock, it just doesn't move very much, right? It trades down to 1950, up to 2050, 2020, 1980. It doesn't move. With 30 days to expiration, if you want to buy 10 of the 22 strike calls, it's $100. You can get long 1,000 shares of stock at 22 for only $100. cheap. 24s, they're worthless. The market is saying within 30 days, this stock can't get up to 24. It's valued at 0. Down $2, 10 cents, down 4, nothing. But if we go to the high volatility stock, and this stock, for example, just last month traded down to 17, and now it's trading 24. Goes back down to 20, goes up to 25, it moves all over the place. So with 30 days to expiration, if I wanted to buy 10 of the 22 strike calls, or said another way, if the stock's at 20 and I want to buy 1,000 shares at 22, it's going to cost me $800 rather than $100 in the low vol stock. The only difference between these prices is volatility. That's it. 24s are worth 30 cents because the market is pricing in a potential opportunity that ABC trades above 24 within 30 days. Same thing, $2 higher, 80 cents, $2 lower, it's $1. $4 higher, 30 cents, $4 lower, 70 cents. Anybody know what that's called? Why did I price my puts more expensive than my calls in this example? You guys know what that's called? It's good to learn. Once you learn it once, you'll look at options differently because the first thing you'll do is you'll look to see if the options market, there you go. Why didn't you jump in with that Black Scholes? That question was this question was even harder. Well done. Skew. So I skewed the market to the downside. I skewed the market to the downside. How about this? There's another one. Why is there skew? Why are the downside puts more expensive than the upside calls? Why would I do that? I was a market maker for 5 years down on the floor of the Chicago Board Options Exchange. We skewed a lot of stocks to the downside, just like this. Why would market makers skew the market to the downside like this? The common answer is that stocks go down faster than they go up. Like Ryan. Ryan just said prices fall faster. I don't know if that's true. Crashing up versus crashing down. You know what? Fear is greater than greed. Fear is greater than greed. Is that? I don't know if that's true. Like, yes, I've heard it before. It's a buzzword. But I haven't really seen any data to suggest that the market falls faster than it rises. I'll tell you why these are skewed like this. And this might make a little bit more sense. Even though fear is greater than greed sounds a lot more poetic. What are the two most popular option strategies? First one's going to be covered calls. A covered call is buying stock, selling upside calls for income. Market makers know that the public wants to sell upside calls. So we're going to make those really, really inexpensive because we're greedy. We want the edge. So I'm going to make those really, really cheap because I know the public wants to sell them. So I'm going to buy them real cheap. I also know the next most popular option strategy for the retail trader is buying downside puts for protection. So market makers know the public wants to buy downside puts, so they're going to make those juicy. They're going to make those expensive. And that's what creates skew, right? That's why I had that logic in the beginning. Walk through it. There's a reason why things are priced how they're priced. This is coming up really small on my screen. Hopefully it's coming up better on your screen. What I'm showing here is, this is so small. Even too small for me to read on my computer. Sorry about that. So what I'm showing here is an upside skew where the calls are priced higher than the puts. Okay? I'll talk you through it. So when you see something where the calls are priced higher than the puts, You don't see that often. That means the market is skewed to the upside. So if you're an outright trader and you don't trade options at all, but you learn about skew and you learn about interpreting how options are priced, the benefit can be if there's a massive upside skew where the options, the call options, are priced dramatically higher than the put options, the market is pricing in a higher likelihood of that stock going higher than that stock going lower. Really good information to use if you're a stock trader. The only industry that routinely has a higher upside skew than downside is going to be biotechs. If you think about the last biotech trade that you made, I'm guessing it's buying upside calls. The public wants to buy upside calls in biotechs because they're playing for the next great drug approval. Biotechs consistently have a skew that's towards the calls, towards the upside. So for the swinging for the fences strategy, and swinging for the fences is kind of a silly name. That's my options program. That's my flagship options program. So whoever comes in to work with me, they take swinging for the fences, and that's where I teach options. That's all it is. And I teach options by teaching how to buy, how to value options, and how to find these inexpensive opportunities. The great thing about these inexpensive opportunities is it's a fixed amount of risk. You know exactly what the risk is before you get into the trade. In order to do this approach, what I'm looking for is two separate things. For one, we want movement. We want things to be moving like crazy, and we want to try to find undervalued options in the market relative to their historical movement. And two, we want something called tradable options. And that comes back to Andy's question about liquidity. If the options are 15-cent bid at 20 cents, that's cool. We can trade in that. We can transact, no problem. We can get in, we can get out. If the options market is 15 cents at $1.50, we can't do anything. No trade. So we do need options to be tradable in order to execute this kind of strategy. So those are the two things that we're looking for. Before I explain exactly how swinging for the fences works, I want to go through a trade example that I personally think is awesome for retail traders. And again, it uses logic. So let me walk you through it. Here's an example, Laureate Education, L-A-U-R. Are you guys, is anyone familiar with lockups? With how lockups work? Awesome, okay. Cool, all right, you guys will love this. So how a lockup works is if a company wants to go public, they're gonna have an IPO, they're gonna go to an underwriter. The underwriter is gonna help them value the company and say, hey, you know, I think we should come out at $10. That values the company at $1 billion if we put out, you know, X number of shares, okay? Company says, cool, let's do it, IPO. But then what happens is they have a lockup. And the lockup is usually 6 months. It doesn't have to be, but it's usually 6 months. And the lockup is saying that any shares that the director has or the company owns, they can restrict because they don't want people who own the company in the private market once it's IPOs to sell on the first day, because then the IPO is not going to go higher, it's going to go lower. So this example, LAUR IPOs February 8th. And at that time, 35 million shares were available to trade. Okay, it shouldn't be a dollar sign, just 35 million shares were available to trade on the IPO date. LAUR has its lockup 6 months after the IPO, just like most IPOs. After the lockup, an additional 133 million, it shouldn't be dollars, 133 million shares that were previously restricted Now they're available to trade. The average daily volume on LAUR, 300,000. Again, that shouldn't be dollars. The average daily volume is 300,000 shares. Share a trade idea July 13th, buying the 17.5 puts with 33 days to go until expiration. So let me walk you through the trade. IPOs, 35 million shares. Think of it like you're an employee. Think of it like, you've been at Laureate Education for 20 years, you got a $100,000 bonus and they gave it to you in stock. And they said, you know what, Susie, here's your $100,000 worth of stock. We're going to do an IPO, but you can't sell it for 6 months, okay? Well, fine. What else am I going to do? So it comes out, IPO at 12. It rallies up to 14 or 15. Now the 100,000 is worth, say 110,000 or 120. You want to get out, but you can't because you're restricted. The stock goes back down. You're sad. Starts rallying. You're like, oh, you get excited again. I wish I could sell it at 15. I wish I could sell it at 17, but you can't. It's restricted. Gets all the way up to 19. Here's where I shared the trade idea with the Premier membership. The lockup expired. Once the lockup expired, 133 million shares that were previously restricted are now available to be sold. So naturally, there's an avalanche of supply coming to the market and there's not demand. So what naturally happens is the stock gets hit. You see this over and over and over again. Great exercise to do is Google the Twitter lockup, the Facebook lockup, the Snap lockup. The last lockup that we played was VNTR. When lockups come out, 35 million shares were traded. Once they release 133 million shares, all of a sudden these people are making 50% on their IPO price. They're probably most likely going to sell. Right? For those who trade only looking at technicals, if they looked at this like a double bottom, they're going to get significantly hurt. I always say, if you're trading off a double bottom, if this is something that you want to buy, and I don't mean this to offend anybody who's a double bottom trader, but how long would it take for me to explain to my 8-year-old what a double bottom is? Probably not too long, right? If we're risking our hard-earned money, we need to dig deep. And that's something that I found once I started working with retail traders. I started Active Day Trader in the beginning of 2016. Okay, it's just me. My wife does customer service. I don't have a trade room with 10 traders or 10 copywriters. But what I notice is, for one, most people trade way too much. Most people trade way too big. And most people that I've encountered are way too reliant on just pure technicals alone. So let me get into swinging for the fences, tell you how the program works, see if it resonates with you. So how swinging for the fences works, and when I first started this, there was a live class. So I would give people a 2-hour workshop. We do a live class. That was swinging for the fences. 2 years later, I've come to realize that, at least in my opinion, there's a void in the market for what I consider to be really good options education. So now, my flagship program, instead of doing a live class at the end of every month, I do a live class at the end of every single month. So anybody who's part of the Swinging for the Fences options program, on the last Wednesday of every single month, forever, you get a live class. And the reason I do this is because when I was talking with my clients, they felt like they were left alone, or they would move forward with a product and there was nobody there to answer their questions, and it was just a sunken cost. And I do this because I have clients who have been in the program for a year and a half, and they have 18 hours of live classes. Keep coming every month. So that's the first thing. Who's this for? Well, beginners, again, it takes time. just like your profession, you know, of the accountants out there, real estate brokers out there. If I went to work for you or work with you, how long is it going to take before I add value to your business? 6 months? 9 months? Longer? I don't think my business is any different. You're not going to learn this in 3 days. It's just not going to happen. It's going to take time, but if you're willing to work, that's why I do live classes once a month forever. Same with those who are new to options. If you're learning options, I wanted to make this so that I'm with you every step of the way. 12 months down the line, we're still coming to live classes. Experienced traders, this group is the most difficult. I said earlier, sometimes I ask that options question and I get a whole bunch of 5s. But then when I go through and ask a few questions, I get crickets. Nobody can answer the questions. Okay? Experienced option traders, experienced anything, have a tendency to be stubborn. You do have to be coachable to make this work. Oh, I lost a whole bunch of slides. Okay. So how this works, so when I'm with TradeStation, I have to submit my presentation. And I submit my presentation, I think there was 50 slides and it came back with 29 slides. So I totally understand. Since this is the last slide and there's like 10 slides that have been taken out, I'm just going to verbally explain the entire offer. Yeah, this is the last slide, huh? Oh. Okay. So how it works, it's unlimited classes. You get one live class every month forever. You also get a 2-hour workshop, which explains the swinging for the fences strategy. I do that so you have something to take away right away. But then I also, in that first couple of slides when I talked about position management, I think position management is by far the most important part of trading. So I also add another hour workshop on position management. So you get 3 hours that's available to you right away, and you get a live class once a month forever. What I'm also going to do is add another 1-hour workshop that covers lockups. After going through and seeing lockups, people are always interested in how I learned that. So for anybody who moves forward, you get 4 hours that's available to you right away, including position management, lockups, and the swinging for the fences strategy. And then every month, you get a live class. The entire offer, it's a one-time payment of $297. There's not any membership that goes along with this. It's $297, and this is options education. Okay? So for anybody who's interested, it's just activedaytrader.com/swing, and it's $297. It's a one-time payment. Again, 18 months from now, you'll have 18 hours of live classes, the recording I send out to everybody. Okay? That sums it up. Sorry I couldn't kind of dig in and explain each one of those, but definitely happy to answer any questions that you have and go from there. The question that I always get is return policy. No questions asked, 30-day return policy as well. So if you start going through the material, or if you go to the first class for you, which will be at the end of February, and it's not what you think it is, feel free, just email me. That's my direct email, or email support@activedaytrader, and you'll cancel anytime. For those two, as you're going through material, if you still have questions, that's my direct email. Email me anytime. Okay? Doug, you please email me as well. I owe you a workshop for that great answer. So just email me at jonathan@activedaytrader, and I'll have my wife, Carrie, enable you for that. Okay, guys? All right. Quiet group is okay. If nobody has any more questions, Tucker, no problem. So William, William asks, how do we find stocks that fit your method? So when you're trading, I think it's really important to define your edge. Let me explain why I have edge in this trade. So if you look at a stock like Apple, Apple has over 100 analysts that follow the darn thing. They have 100 market makers. If you look at the volume and the analysts and the market makers, it's one of the most perfectly valued stocks in the world. By definition, the more analysts, the more liquidity in a given name, the better value it has. I don't trade Apple. I have no edge in Apple. Okay, leave Apple to Goldman Sachs to value. Where I can have edge is finding stocks that are off the beaten path, that still have decent liquidity that we can transact. So William, what I do in Swinging for the Fences, and this comes in the 2-hour workshop that you receive immediately, is I go over the scans that I use for the Swinging for the Fences. I also go over how to find volatility in the market. Because I don't want to just look at the VIX. I want to look at what volatility is doing in oil, what volatility is doing in gold, what volatility is doing in Brazil, what volatility is doing in China. If Brazil volatility is twice the level of US volatility, I'm going to look for Brazilian names, PBR, EWZ, and a host of others. All great little names that have really good liquidity. Okay? But William, that's what I teach you. That's the secret sauce. I want to find stocks that move like crazy, that are undervalued in the market. Okay? So Jess, that's exactly what I teach, how to find those. And it's a longer explanation than just, at the end of a webinar. So Tucker, the way I structured this is my flagship options program. It's $297, you're all in. I do this because I think I can teach options just as good or better than anyone that I've come across. So this is all education. You get the 4 hours right away, live class once per month. Where I share trade ideas is in my Premier membership. But my Premier membership, when I share ideas, they do need to be learned. Okay? I don't think trading is easy. I don't share trades that are double bottoms and head and shoulders. They're all going to be event-based ideas. And then I go into the options market and try to find some good value. So the Premier membership, I do share trade ideas, but you got to learn. You need to learn how to manage your position using stock. You need to learn why we're in those trades. And so again, that's why I make it, the feedback has been extremely positive about this. Patricia, is there a time limit on the offer for the classes? So Patricia, there's not a time limit. Normally what I do for the bonus for the lockups, there'll be a time limit for that. But if you just email me and say, hey, can I have the lockups? I'm probably going to say yes anyway. So, Tucker, yeah, the idea is for you to be able to fish on your own. That's why I set it up like this. Yeah, I mean, you really do need the education. Okay, and again, that's why I make it extremely fairly priced, because when people come to me and they just want to come and take trade ideas, when I first started Active Day Trader in the beginning of 2016, I grew really fast, but I grew in a way that was making me uncomfortable, because I'd have people come to me and they would treat me as a trade service, and if the trade worked, they thought I was smart, and if the trade didn't work, they thought I was a dummy, and they were on to the next guy. And it was driving me bonkers, because trades that people thought weren't good, I had coaching clients who were making money on the same exact trades. If you have 10 people taking the exact same trade, exactly the same, you are going to get 10 completely different results, depending on how that person manages the trade. I'm a big believer that you don't do any trade in isolation. Every trade that you make fits into a part of your portfolio that needs to mesh with your other trades, with your other holdings in your portfolio. And I think people get into a lot of trouble if they hold 5 different stocks or options or futures, and if they look at those in different silos, if they look at those in isolation. And what happens there is that you end up taking off the good trades and holding the bad trades, rather than take a step back and look at things from a portfolio perspective. The same way you would do with a long-term investment account, you're not looking at each different holding individually, you're looking at the performance as a whole. And that's what I try to teach with the membership. Do I teach you how to do the setup of scans, or do they come with the class? So I teach a few different ways of finding these trades. In the scanner that I use is FinViz, F-I-N-V-I-Z. It's free. I just show you the parameters that I look for when I'm doing the trade. And then the other thing that I do to find these trades is, if you guys go to the CBOE and look at their volatility indexes, you'll see they have the VIX, but they also have like 30 other volatility indexes. So OVX is going to be the volatility of oil. It's a common misconception, at least that I find, that people want to buy volatility when it's low and sell volatility when it's high. Right now with the VIX at 40, I sent a note to my Premier members on this past Friday that we shouldn't be selling any options. Okay? You don't want to sell options when the VIX is at 40. Very, very, very dangerous. That's the time where the market's moving. You want to find inexpensive options that are not reflective of that VIX high price. Andy is asking, how much is the Premier membership? The Premier membership is $7. I have a $7 trial. I'll throw that in the chat. And then it's $147 after that. Let me explain how that works, because it's kind of cool. Every Sunday, I always wake up like at 5 o'clock. I'm like one of these crazy early risers, and usually take 3 to 4 hours researching trades. And I build a spreadsheet, and then I share that spreadsheet with my Premier members. And I also share a video, 10 to 15 minutes long, that walks you through each one of those trades and why we're in there. I need a reason to be in every trade. I send that out Sundays, and then on Monday, we do a 30-minute class where people can come, ask whatever questions they need. I go over the trades again, send the recording out right away. And then throughout the week, I'll send out Premier alerts when it's necessary. But overall, it's not death staring the screen right away all day. We want to make good decisions. We want to relax. I spend most of my time outside of the market looking for opportunity. When I do a trade, it's usually put a limit order in at this price because I'm comfortable buying, say, at 30 cents. If we get the trade, good job, great trade. And if you don't get the trade, no harm, no foul, no risk. So that's how I look at the market. Okay, so it's $7. If you want to continue, cancel anytime. $147 after that. You get the trades every Sunday night. You get the class Monday, and then Wednesday I share the same thing in futures, mostly bond futures, because that's where my experience lies. Okay. All right, guys. Well, thank you very much for hanging out with me. If you have any questions, again, that's my direct email. Feel free to email me anytime. I'm usually a pretty quick return getting back to you.